Hi, everyone. My name is Emily Black, and I'm presenting Algorithmic Fairness and Vertical Equity, Income Fairness and Tax Audits, which is joint work with Hadi Elzayn, who's also first author, Alexandra Chouldechova, Jacob Goldin, and Daniel Ho. In this project, through a novel collaboration with the United States Internal Revenue Service, we investigate the impact of using machine learning systems in the IRS audit context as the IRS looks to update its audit selection system. We investigate what steps can be taken to prevent inequity from AI systems in the audit context. We focus on investigating the fairness of audit allocations with respect to taxpayer income. To do so, we borrow from the public finance literature to introduce a new fairness framework called vertical equity. Vertical equity has to do with treating different people appropriately differently, as opposed to horizontal equity, which concerns treating similar people similarly, arguably the focus of most common fairness definitions in the literature. We find that many off-the-shelf fairness interventions can be ill-suited for the IRS audit context, both due to their imperfect fit of their implementations with a budgeted allocation problem, and also their mismatch with contextualized fairness desiderata, such as vertical equity. This ill fit of common bias mitigation techniques may be relevant to a wider set of policy contexts, pointing to a need for better tuned fairness metrics and bias mitigation techniques for many policy problems. We'll start with some background on the IRS. Taxes fund the US government, but tax collection doesn't always work perfectly. The estimated yearly tax gap, or difference between amount owed and amount paid, is about $450 billion, or 20% of all income tax liability. In order to recover lost revenue and deter noncompliance, the IRS audits individuals by investigating tax returns which suggest noncompliance with the tax code. How audits proceed often depends on where an individual is on the income spectrum. While higher income individuals may receive a request for excess tax liability after an investigation, lower income individuals are often audited about potentially falsely claimed credits and have audits done through correspondence where the refund is denied prior to the investigation. Audits can pose a heavy burden on everyone as they can be stressful, time-consuming, and they can even lead to financial hardship. According to the National Taxpayer Advocate's National Report to Congress, this is particularly true for low-income individuals. Given the high-stakes nature of IRS audits, it's important that we find an audit allocation system which distributes audits equitably with respect to taxpayer income. This is the focus of this project. With this in mind, we endeavor to answer the following questions. How can we make a machine learning-based audit selection system as fair as possible with respect to taxpayers' income? In this work, we present the following contributions. We introduce vertical equity to algorithmic fairness. We show that high complexity models can sometimes exacerbate vertical inequity. We demonstrate that classical fairness promoting interventions are not well suited for budgeted policy problems. We show that changing a model's prediction target instead can improve fairness while avoiding a steep performance fairness trade-off. And finally, we demonstrate that agency constraints and policy choices may have a strong influence on audit allocation equity. In our work, we explore real IRS tax data. We use two data sets. One, the National Research Program data, or NRP data, which consists of line-by-line audits of a stratified random sample of the US population from 2010 to 2014. And there's also operational data from 2014, which are risk-selected audits to identify tax evasion. Each observation contains information filed in a tax return, and all dollar amounts are adjusted for inflation to 2014 dollars. We train our models on NRP data since it's a random sample, but we start with investigating the status quo audit behavior on operational audit data. We begin our investigation by presenting some motivating facts about the status quo of income tax audits. Here we have a graph of the IRS audit rate by income in 2014. The y-axis is audit rate, in other words, percentage of the population audited, and the x-axis is income in thousands. Each point represents the audit rate of a bucket of individuals whose income spanned $10,000. We highlight two motivating facts. First, in most recent years, the lowest income earners have been audited at the same rate as the highest income earners. This red line indicates that individuals making less than $50,000 have the same audit rate as individuals making between $700,000 and almost $1 million in income, with everyone else in between audited at a lower rate. When we replot this graph over income deciles, in other words, groups of 10 percentiles of the US audit population, where the x-axis is now income in thousands for the lower bound of each 10 percentile bucket, and each point is the audit rate of a decile of the population, we see that the lower to middle income deciles are audited at the highest rate, and that the spike from the first plot makes up about 30% of the US population. However, consider this graph of tax misreporting, in other words, noncompliance by income decile. Again, the x-axis is income in thousands for the lower bound of each decile, and the y-axis is the rate of noncompliance over $200. We can see that noncompliance increases roughly monotonically in income. This leads to a motivating question that will influence our understanding of equity in this context. If misreporting increases monotonically in income, then why does audit rate focus so heavily on the lower to middle income classes? We quickly formally define the audit problem before moving on to our understanding of equity in the income fairness context and our main results. The simplified audit problem is to choose audits to maximize revenue subject to a budget, where we view the audit budget as a percentage of the population, in this case, 0.644%, based on the average audit rate from 2011 to 2014. In practice, we approximate the audit allocation problem with maximizing the sum of output from a machine learning model, so expected tax liability for regression models or predicted probability of misreport for classification models. Thus, after model prediction, this amounts to selecting individuals for audit in order of greatest prediction. We note in practice that the IRS auditing problem is much more complex than simply maximizing revenue, but also has to balance other goals such as deterrence. Our goal in this project is to create an allocation which is as equitable as possible without greatly decreasing revenue or increasing the rate at which the IRS audits individuals who do not owe extra tax, called the no change rate. With the simplified audit problem and relevant background in mind, we discuss what equity with respect to income means in the IRS audit context. So what are the fairness desiderata in the IRS context? To understand this question, we borrow a fairness framework from the public finance literature, namely vertical equity. Vertical equity is centered around the idea that individuals or groups with relevant differences between them should be treated appropriately differently. Arguably, algorithmic fairness is often centered around the idea that equity means that people are equal in all respects and thus should be treated similarly. This leads to equalizing rates of some sort or another across demographic groups. In tax policy, this concept is called horizontal equity. Contrastingly, vertical equity acknowledges the differences between people, like differences in income and wealth, and posits that people must be treated differently because of their differences in order to achieve fairness overall, like our progressive tax code, which taxes higher income individuals at higher rates. Vertical equity is not a fairness definition, but rather a framework or a vantage point from which to think about fairness desiderata. It requires information and assumptions about a given context to be meaningful, like what are relevant differences and how should they be appropriately accounted for. We offer just one interpretation of vertical equity in this context. First, given that audits may pose varying burdens on individuals with different income, and in particular, lower income individuals may suffer a greater burden from a tax audit, we give preference to audit allocations which decrease audit focus on lower income individuals. Formally, we prefer audits that have audit rates, we prefer allocations which have audit rates which are more monotonic in income. Additionally, we prefer allocations which are close to that of an oracle under the same budget, where an oracle is a model with perfect knowledge of every taxpayer's true misreport and selects to audit in order of magnitude of excess tax owed. Note that this is not just an accuracy requirement. Since the audit problem involves selecting up to a budget, this means that the model should also rank similarly to an oracle. We measure this by calculating the oracle overlap, or the ratio of the size of the intersection of the oracles and a given model's audit allocation at a certain budget over the total size of the allocation. To recap, we want to increase vertical equity, so we prefer more monotonic allocations with a higher oracle overlap, but we also want high revenue and low no change rate, in other words, the rate of auditing individuals who do not actually owe excess tax. I'll now turn to our results. With this in mind, we turn to the impact of higher complexity classification models on allocations. We found more complex classification models do increase accuracy and thus reduce the no change rate, the percentage of audits on people who do not actually owe extra money, to 3% from about 13%. Given that probability of misreport increases with income, it may seem natural that higher complexity models would shift audit focus to high income individuals. However, we found that high complexity classifiers actually exacerbate audit focus on lower income groups. We can see the difference between audit allocations of high and low complexity models in the following graphs. Here we have the audit rate by income of the allocation of a simple LDA classifier. On the y-axis, we have audit rate, and on the x-axis, we have income in thousands per income decile, where the income is at the lower end of the decile. The black line shows that the audit rate by income of the LDA allocation. The red line shows the audit rate by income of the Oracle allocation. Remember, this allocation is only the top 0.644% of the taxpayer population, not all positive predictions. When we switch to a random forest classifier here on the right, we see that while the accuracy does improve as reflected in the low no change rate, the more complex random forest classifier exacerbates focus on the lower to middle income portion of the population and does not audit the highest income groups at all. Thus, we see that here, higher model complexity can lead to higher vertical inequity. To fix this problem, we first tried to use some of the many common bias mitigation techniques to decrease audit focus on low income groups. While we present other definitions in the paper, here we only focus on equalized odds, which is defined as the requirement that compliant or non-compliant taxpayers' probability of audit should not depend on their income. We implement equalized odds on random forest classifiers using Fairlearn's implementation of Agarwal's et al.'s a reductions approach to fair classification. We found that these techniques are, firstly, ill-suited for the IRS audit context and potentially a greater group of policy problems due to their incompatibility with a budgeted allocation problem. We also saw that these techniques led to minimal vertical equity gains due to not optimizing directly for vertical equity, and that even these marginal equity gains incurred significant deterioration in no change rate and revenue. As an example, consider this graph of the audit rate by income decile of an equalized odds constrained random forest classifier in blue. The x-axis is income in thousands of each income decile, and the y-axis is the audit rate. The black line is the original random forest classifier's audit rate by income, the red is the oracle, and the blue is an equalized odds constrained random forest classifier. In other words, the model that was trained to have all income deciles have the same true positive and false positive rate. Although this isn't directly obvious from the graph, I'll first note that the budgeted nature of the IRS audit problem prevents these off-the-shelf methods from performing as billed. While equalized odds is satisfied over all positive predictions, it's not satisfied over the top 0.644% of the population. Secondly, there's only a marginal equity improvement here. The audit rate is higher on the lower to middle income classes than the highest income classes, and the oracle overlap is only about 4% of the allocation. This provides evidence for a mismatch between mitigation techniques and the contextualized fairness desiderata. Finally, we see that these marginal equity gains from enforcing a fairness constraint during training leads to very high trade-offs in this setting, a revenue loss of $2.52 billion from $3 billion originally, and increasing the no change rate by 10%. However, we find that there is another way that we can increase vertical equity in this setting. We find that it's possible to improve vertical equity by changing the audit selection model's prediction target from classification to regression. That is, we predict the expected amount of misreport per individual instead of the probability of misreporting. Additionally, this leads to a $7.17 billion increase in revenue, while it also increases the no change rate by 19.8%. Given that other methods decreased revenue and increased no change rate, this arguably decreases the overall trade-off. In the black line in this graph, we see the audit rate by income decile of a random forest regressor model, which predicts the expected amount of misreporting. The red line is the oracle allocation. We see a larger vertical equity improvement than the off-the-shelf methods, increasing oracle overlap to 23%. And we see that the allocation, while not perfectly monotonic, closely reflects the monotonicity of the oracle. And we have lower trade-offs. While there is a large increase in the no change rate, we increase revenue by 7.17 billion, reaching total revenue of over 10 billion as opposed to 3 billion in a classification model. This shows us that lower level modeling interventions, such as changing prediction target, can be effective at increasing fairness in real world settings. We close with investigating how agency constraints affect audit allocation equity. Due to budget realities and policy decisions, targeting lower income individuals is extremely resource efficient. When considering the IRS budget as a dollar amount in a strictly return on investment-based approach, targeting low-income taxpayers is the most effective way to maximize revenue. We can see this in this graph, which shows that audit allocation selected with an optimal return on investment-based approach for all machine learning models considered in our paper with budget as a dollar amount. We have audit rate again on the y-axis and income per income decile on the x-axis. We see that this return on investment-based approach leads to all allocations focusing almost exclusively on the lower and middle income individuals. I'll end with some takeaways. To summarize, this work shows us that modeling changes, especially those not related to fairness on their face, can successfully increase fairness in real-world settings. Second, it shows us that off-the-shelf fairness mitigations may not work well in budgeted policy problems. Finally, it reminds us that agency constraints and policy choices strongly influence equity in real-world policy settings. Thank you so much for reading our paper, for listening to our presentations, and please read our paper for more. Thank you.